Apple continuing to be in what you could call a difficult period. The tech giant coming off its worst quarterly performance relative to the S&P 500 in over a decade, as it's dealing with a high-profile antitrust battle with the Department of Justice, falling iPhone sales in China, and a regulatory investigation in the European Union to top it all off. Shareholders waiting for positive signs that could spur rotation for the tech giant. So to discuss what's next for Apple, we've got Craig Johnson, Piper Sandler Managing Director and Chief Market Technician. Craig, thank you so much for being here with us. Talk to me about what's next for Apple. Is there any potential for further downside from here?
Well, there's a lot of headwinds. There's no question for Apple at this point in time. But when you step back and you look at the company overall, it is a very obviously high quality blue chip company that's been doing very well for a very extended period of time. You could also add to the list of problems that handset sales have not been terrific in China. But at this point in time, with a market that looks like it's setting itself up for a good 5 to 10% correction, Apple looks like a pretty attractive place for people to park their money at this point in time, because it has got a great balance sheet, B, a highly repeatable business model, C, good margins, and D, I would say they're buying back quite a bit of stock. So if you're looking to put money in sort of call it a safe haven trade at this point in time, and a company that's got a better balance sheet than the US government, Apple's probably going to be the safe haven trade. And when you look at the chart that we've got here this morning, you can see that you're still in a very nice longer term upward trending channel. You're now the midpoint of that channel. And from a risk reward standpoint, you got probably about 10% downside, 20% upside. So despite the disappointment and underperformance this year, this could be a rotational stock for investors that are looking to hide.
All right, Greg, we have one of the charts here up on your screen. You outlined some critical levels that need to be watched here within some recent reports, just in terms of the pullback that we have seen in Apple, whether or not it's going to test that October low of 165.67. Craig, when we talk about whether or not the worst of it is behind it for Apple, is it fair to say that you think that is the case?
Well, from a pure risk reward standpoint, there's probably going to be further negative headlines coming with all these antitrust issues to get played out. That being said, thinking about differentiating the company from the stock itself, you look at the stock itself, again, you got probably 10% downside risk and about 20% upside. So 2-to-1 risk reward at this point in time. I'd also just note there's a lot of investors that have owned the stock over the years, don't want to sell it for tax purposes at this point in time. So I think they're going to be pretty patient with the stock. And as the stock pulls back in here, I don't think you're going to get as much selling pressure, simply because this is such a well-loved company and a company that's got such a solid balance sheet.
So not only could the worst be over for Apple, but do you see a potential upside to Apple, particularly as investors? I know you've mentioned kind of trade in and out of the Magnificent Seven stocks. Is there a potential upside ahead here?
Yeah, absolutely. The stock could certainly trade back up to the upper end of the trading range, which is closer to 180. Again, that's a nice setup from here at these levels. And again, there's new innovative products coming out like the Apple Vision Pro. It's going to be small initially, but for those that have looked at that new particular product, it's a pretty impressive product with a lot of capabilities, and certainly helps lay out the roadmap for what's ahead. So there are some positive things on the horizon for Apple that we shouldn't ignore.
Craig, I'm curious from your perspective, what do you make of the divergence that we've seen in a number of these larger cap tech names since the start of the year, really going back to the end of last year, and what that could signal then in terms of some of those investing trends in the coming months?
Yeah, think about the Mag 7 coming off of and even the Fantastic Four, but the Mag 7 and the Fantastic Four coming off of these October lows of last year, they have clearly led the market higher. They've also been very concentrated bets for a lot of individuals. People haven't wanted to take profits in those names. At this point in time, if you just come back and look at the charts of those particular companies, they're not making new highs anymore. So we've often been looking at these sort of Mag 7 stocks in 2023 and in 2024 as potentially becoming the Lag 7 stocks, as they're not relatively outperforming in the same way. Clearly been the case for Apple this year. I think you're getting a market that is starting to say, I got to take some money off the table. The risk to reward at this point in time for some of these companies is just too stretched. Some of those Mag 7 stocks, specifically thinking about specifically thinking about Nvidia as an example, which has been clearly the dominant one-play stock in the market, you're trading 50+% above your 200-day moving average, and you're now not seeing the stock making new highs. The momentum investors out there are going to start to lose religion on some of these stocks if they don't start to see an improvement. I suspect that's going to be the case, and that's why I think you're going to get a 5 to 10% correction in the market and see some of these stocks that have been such winners actually come back in and watch the market diversify.
Craig, last question for you. What are you hearing most from clients about the Magnificent Seven trade and what's next for that trade?
Well, the common question for a lot of investors and institutions is, why should I sell these names? They still remain in uptrends. And the answer to the question, and then also what's going to be the catalyst for a correction in the market? Well, the catalyst for a correction in the market is becoming obvious. I mean, the prior guest that you have on is talking about the Fed, talking about interest rates. And what I will tell you is you've got a breakout happening in 10-year bond yields right now. And if you start seeing 450 or 460 on the 10-year, I can't imagine that the equity market is going to hold up well under that scenario. And that's going to lead to at least a 5 to 10% correction. You could actually see this market pull back toward 40, the S&P that is, pull back toward 4,600 to 4,800, I think, over the next several months, giving us a better entry point for not only Apple, but also a lot of these Magnificent Seven stocks. And you would also watch the market broaden out from our perspective. So we've raised cash. We've raised our recommended, we've lowered our recommended equity to 90% from 98%. So you got to be a little more careful in here right now.
All right, Craig, we're going to have to leave it there. Thank you so much for joining us on all things Apple and Big Tech. That was Craig Johnson, Piper Sandler Managing Director and Chief Market Technician.